Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
I saw sugar in New York, my apologies there. Until 4 weeks ago, the market had, for the most part since mid-January, run down along the underside of the purple highlighted upper time, currently at 1751, of the early November 2023 to mid-January 2024 bearish shift pitchfork. In late February for a few days, and then in late March until early April, there'd been strong drives higher over the upper time, but the moves failed, and the bearish shift pitchfork repaired itself. The earlier attempts higher had defined some overhead resistances, notably the declining short-medium moving average, currently at 1917, and the stratified familiar congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. And I'd like to add on to this the mauve highlighted declining medium moving average, currently at 2057. Indeed, the general zone between 21 even to 2010 has seemingly a lot on top. 7 weeks ago, the market pushed down through the bright red highlighted April 2020 to date uptrend, currently at 1968, and then down through the next uptrend, the bright green August 2022 to date uptrend, that's currently at 1897. But then the move lower got stuck at the significant 21st century 50% absolute Fibonacci line at 1809. Enough that after 3 weeks of trying to push down through it, prices turned and drove higher, over the breached bright green uptrend, and most recently over the breached bright red uptrend. This broken red uptrend was not on its own as resistance, as coming in from above was the previously mentioned short-medium moving average, currently 1917. This moving average had effectively capped the market back at the start of April and started doing the same again over mid-June. However, I mentioned last week a new pattern, and I quote, a possible nascent bull channel formed over late May into early June, end of quote. This week I finessed this pattern from a bull channel into a bullish expanding wedge pattern, highlighted in pink on my daily chart. And initially I did not have much faith in this pattern. As I said 2 weeks ago, and I quote, I'm inclined right now to look at this skeptically, as we are also still within the previously mentioned dark blue highlighted late February to date bear channel. And that's currently at 1684 to 1950. Now, I realize I've not yet mentioned this bull channel, so I better get on with it. It is highlighted in dark blue on my daily chart and has taken on driving the market lower along with the purple upper time since about April. Anyway, last week prices exited out of this pattern at the same time that the market went over the bright red breached uptrend. I've also pointed out an interesting feature about these patterns that I expanded upon last week, and I quote, what I find interesting is that since roughly mid-April until 3 weeks ago, so that's 4 weeks ago now, until 3 weeks ago, the market had been corralled in between the purple upper time and the dark blue lower bear channel line. The corralling has been enough of a move that since mid-April, these two lines have created a descending wedge pattern. The primary target X for such a pattern is up about the 2023 area for stronger, and that's the target X, with a harder to reach secondary target X1 up in the 2092 area. End of quote. I had strong doubts about the market getting as far as that primary target X, as prices remained within the dark blue bear channel. We needed to break up and out of this pattern, and soon. Plus, there was the previously detailed overhead congestion. However, last week prices broke higher and reached target X at 2023. Now, a word of caution. As I said last week, and I quote, this very recent break higher could be a blip upwards before turning back down, which you sometimes get in such moves. But to verify that, we need to turn back lower within this or maybe next week. So that's last week or this week now. End of quote. That is why I'm paying special attention to what the market does immediately overhead with the approaching descending medium moving average. Ice Europe white sugar in London. The market from the middle to end of January had been wading through stratified levels of support and turning them into resistances above, such that prices had a changeover gap in mid-April between 613.40 down to 580.30. During the rest of April and the start of May, prices tried to move up and fill this gap, but the success was minimal, and instead we saw the creation of a bear flag into the middle of May. This brings me to a point I raised 11 weeks ago, and I quote, Over the last few weeks, I have been voicing a question here that I've been posing to myself. It is this. Is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern? Last week it was still too early to tell, but I'm more confident now that the late December 2023 today action is perhaps a possible descending triangle. I've outlined the triangle on my daily chart in bright red, and that's currently 598.20 to 635.60. This is a pattern to watch just in case it morphs into something else, end of quote. I also added the following 9 weeks ago, and I quote, now that we are here, it would seem appropriate to set up some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, a primary target X for such a pattern would be down in the 544.80 zone, whilst a harder secondary target X1 would be down in the 497.60 zone, end of quote. 7 weeks ago, prices moved down and reached the primary target X, leaving just the harder to reach secondary target X1. I will now retire a target X1 at the end of this commentary. This brings me to the very recent action, the creation of a small nascent bull channel, currently 552.30 to 579.70, which is highlighted in dark blue on my daily chart. Last week I was concerned by the declining short medium moving average, currently at 560.80, impacting the market. I needn't have been concerned, as early last week prices punched up through this moving average, as well as the dark blue upper bull channel line. I also added the following commentary from 2 weeks ago, and I quote, one thing I know, that breaking up through the green short medium moving average could set up the bright red lower trend line of the descending triangle into the frame for this market, end of quote. Well, today, and indeed last Friday, prices have moved up to test the bright lower trend line, bright red lower trend line, which is over the declining mauve highlighted medium moving average. So far, the market has rejected at most to punch through it and try and fill in the gap. Separate to the gap, we have congestion overhead at 602.70, 606.30 to 608.30, then 614.30 and 619.10. So there's a lot on top that could cap any rises. As I said over the last couple of weeks, and I quote, so you can see there's a lot riding on this one big gap, end of quote. Sugar white premium spread. I'd previously spoken here some while ago about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the lower time currently at 142 and a quarter, tested, breached and possibly on the verge of being broken. We also have down here all the moving averages between 130 and 3/4 to 140 and 3/4. Meanwhile above, we have the congestion at 153 even, at the 2013 high, and then between 162 and 3/4 and 164 and 3/4, that had until recently the rising neckline extension of the June 2021 to May 22 reverse head and shoulders bottom, that's currently at 167 and 3/4, plus the 2012 high at 164 and 3/4. There's also some further congestion above between 173 and 3/4 to 175, though after this we have a pretty clear area topside until over the congestion at 178.5, all the way up to the dark blue middle time, which is currently at 216 and a quarter. And that's of the same bullish Andrews pitchfork. 11 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London Sugar Month changeovers, but it nevertheless still effectively countered the previous week's bullish closing white Mariposa. Thus, it is best to consider the dark blue lower time along with all the nearby moving averages as the key elements in this market, and no more than that for now. So, we come to the action of 2 weeks ago when we had a combined key reversal up and bullish engulfing pattern. Back then, prices closed for a third consecutive week below the medium moving average, currently at 140 and 3/4, as well as the dark blue lower time, if only just by a whisker on both, but still above all the other moving averages. It was nevertheless not a conclusive or strong close lower. There was an appetite that week to try lower, but the resultant weekly key reversal up and bullish engulfing pattern indicated it wasn't that strong and was quickly rebuffed when it was tried. I can add to this my comments from 2 weeks ago when I said, and I quote, "This has been the first time prices had been below the lower time since that break lower in early February 2023. That earlier break was swiftly turned around the following week. Thus, I would continue to pay special attention to what happens over the next couple of weeks and whether prices can maintain this bearish incentive, and perhaps finally break down properly through the 50% Fibonacci line at 128 3/4. End of quote. However, the market was not able to head lower, and as I said 2 weeks ago, and I quote, I have a suspicion that this market might go the way of the February 2023 action and rebound back up. End of quote. Well, last week it did, with a strong move higher over the dark blue lower time and up to test the 2013 high at 153 even, and nearby lesser Fibonacci line at 155 even. This week, and we have already opened lower, down below the dark blue lower time and into congestion of the moving averages. Now, this doesn't mean the rally's over. Prices have rebounded today, but it does dent prospects for the bullish incentive. Let's obviously keep an eye on that overhead blue lower time, or it's now just underneath, but also below on the 250% Fibonacci lines at 131 1/4 and 128 3/4. Looking back as far as November last year, you can see that we rarely venture there, and when we do, prices do not close anywhere in there.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.